I can hear you. Can you hear me?
Yes, sir. Very good. As usual, appreciate those that keep joining these spaces that I run more like a crowdsourced podcast. I was popping into a couple of spaces last night. I am amazed at how some of these things candidly are run. It's like a whole bunch of people just arguing with each other, which I'm not that interested in because that doesn't help anybody. So with that said, please, if you're going to come up, don't argue too much. Make sure that you follow me, check your DMs. We'll coordinate down the questions, and I'll prompt you when the time is right. I'm excited for this conversation. I've known David for quite some time. He's a remarkable analyst and a very good human being. So if you don't follow him, you unequivocally should. My name is Michael Agaya, publisher of the Lead Lag Report, as well as portfolio manager of the ATAC Fund family at Tidal Financial Group. Joining me for the hour is Mr. David Dierking. David, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get involved and interested in markets? And what are you doing today?
Yeah, well, first of all, good morning, everyone. Thanks for having me. I'm excited to be here. I've been listening to these spaces for quite some time, and I'm excited to be a part of it. Thank you for that kind introduction. I think you probably overshot a little bit. I merely tried to stand on the shoulders of giants. So thank you. That was very kind. I am the writer of the ETF Focus blog over at thestreet.com. I've been in the industry probably for about 25 years now. My original job coming out of college was I worked the midnight to 8 shift at the call center of a small mutual fund company. So I would not recommend that for anybody who's considering a career path. I did that for about 8 years or so. I moved over to BMO for about 10 years or so, jumping around different roles over there. And everything changed actually when I decided to actually leave my career, and I was going to be a stay-at-home dad for a while for both personal and professional reasons that we don't need to get into here. But that was probably the best decision I've ever made for myself. That is something that I would recommend in case you're ever thinking about that. And as of my girls were getting a little older, I decided to kind of get back into the writing side of things as means of sort of staying up with the industry and following what other people were doing and saying. I had a small ETF blog on the side that was independent, and I got a call from the street. They wanted to pick it up and publish it on their site. So it's been over there for about 3 years now, and that's pretty much what I've been doing since. I've crossed paths with a lot of smart people, learned a lot along the way, and excited to be here and talk with you today.
So you talk about being a stay-at-home dad and tracking markets and raising your kids. Obviously, um, did you ever find it challenging to not be stressed when you look at markets and not have that impact the home life? Because that's always a challenge, right? I mean, it's a very difficult domain to be in because you're not in control of market movement. You're trying to figure out the unknowable tomorrow, like everybody else, and yet you still have to be able to be the calm dad, even though you yourself might have your own anxieties because of market movement.
I don't know about that. I've always kind of been the person who's been more of a long-term investor. I've never really been a trader, so I've always kind of been able to compartmentalize a lot of that. I would invest my money, and I'd never really look at the quarterly statements or anything. I didn't really follow it more closely until the last few years, really during the pandemic when everybody was shut inside and really had nothing better to do with their time. But as far as that, I've never really reacted to stuff too closely. Even when stocks were falling 30% during the pandemic, or even the last year, I kind of sat on the sidelines and just watched it happen. Anytime I've tried to move in and out of the market, it's generally been a failure and something I shouldn't have done. So I generally stay with buy and hold. I still hopefully have years to go to be doing this. So I know a lot of people panic about that stuff. They watch it go up and down and try to move in and out. I've never really been that kind of person. So I don't like to see my accounts go down any more than anybody else. But I guess it's never really caused me a lot of stress. I just kind of buy and hold, just let it ride. Hopefully another 15 years down the road, it'll be there for me.
Yeah, and that's always the funny thing, right? It's like people get nervous about drawdowns and volatility, but it really is true. Unless you need the money tomorrow, it not only shouldn't matter, but it shouldn't affect your emotions. But in reality, it does. I mean, you've seen the same studies that I've seen that show that the joke about buy and hold is that rarely do people actually hold.
Yeah, and I mean, I think all that pretty much you can make when you think you can beat the market. I did a little trading back during the tech bubble. I did a little trading during the COVID pandemic, and it didn't work out. You know, stupidly thought I could have options for a little bit, and that didn't really turn out. So I've learned enough to know that I'm not really good market timing or trading or anything like that. So you know, it's a boring answer, but I found the best solution for me is put my money in a total market index fund and just kind of leave it there. That's served me much better than anything I've done on my own, really.
So, speaking about boring, you can make an argument that ETFs can be remarkably boring. I mean, a lot of people still want to have stories around individual stocks, and I talk to a lot of advisors. A lot of advisors tell me they do individual stocks because their own clients want to have something to kind of latch onto as far as the narrative. What turned you on to focusing specifically on the ETF space in general?
Well, like I mentioned, I started out in the mutual fund industry, and that was kind of the thing at the time in the late '90s and the early 2000s. So um, I, that's kind of how I got my start. That's kind of the direction I was interested in. But as time went on, it became pretty obvious that ETFs were the way that the industry was headed. So I thought the premise behind ETFs largely just made a lot of sense because on the mutual fund side, almost everything was actively managed. All the expense ratios were 80 basis points, 100 basis points, what have you. And you see all these studies out there that show that over 3, 5, 10 years, it's like 80, 90% of the funds like the index. So once folks just track the index, it's a lot easier. It can be a lot cheaper. So then you have, Vanguard comes along, they start offering ETFs at like 3 basis points. And, suddenly just matching the index, these funds were outperforming 80% of the funds out there. So that's just a very it's just a very simple strategy to follow. It's not sexy. It's not exciting. You flip on financial media, and all they want to talk about is Tesla and Coinbase and Bitcoin and all this and that. And that's great. That can work if you time it at the right time. If you hit it just at the right time. But I think for long-term investors, the idea of just putting your money in a broadly diversified product and paying as little as possible just makes a lot of sense for the vast majority of people. So, it starts out as basic broad index or sector funds, and then we've seen over the last few years that's really blown up into, ETFs allow you to invest in pretty much any market segment, niche, strategy, factor, you name it. It just gives investors basically access to anything in the world that they would never have had access to 25 years ago unless they were a high net worth investor, had the inside track from their broker. So I just think that makes a lot of sense. I think it's great for investors from a cost advantage standpoint. They can build portfolios whenever they want. And yeah, but again, I think just for the most part, this strategy just really makes sense for the greatest number of people.
Yeah, and I'll get into some of the audience. I think it's important to distinguish sort of what's truly active. I mean, a lot of the studies show correctly so that passive beats active, and a large part of that obviously is because of the fee of these kind of passive ETFs versus active. But I always have this dilemma in thinking about what active really means. If you have a fund that overweights Apple by 250 basis points, they might call themselves active, might be categorized as active, but yeah, that's not really much of a difference. The R score is still going to be pretty high. How do you think about sort of what a true active strategy really should look like? Because I do think that the definitions do matter when it comes to the analogy of active versus passive, or the discussion on active versus passive.
Yeah, I think the example that you gave is the perfect example of a closet index fund, and I really hate them because if you're just tilting 50 basis points away from that, well, 50 basis points towards Tesla or something in there, and you look at the active share of the fund, it's still 10%, and it's still has a 99% correlation with the S&P 500. That's not really doing much. It's good. I think you're probably paying way too much for something like that you can just get out of an S&P 500 fund that charges 3 basis points. So when I consider active trading, I want something that actually has a little bit of a higher turnover, something that's different from the index by a significant margin, for as much as Kathy Wood's polarizing figure, and people love her or hate her funds, but she is a true active manager. She's got products out there that don't look anything like anything else. Um, she's trading constantly, trying to move in and out. Results during good times are great, results during bad times are awful, but something like that is true active fund. So I like to see stuff that provides true differentiated product from what you can get in index. I think it should be very distinct, very different. And if you're calling yourself a
go to some of the audience. FCF, go ahead.
Hey guys. And that was something morning, man. That was something I was gonna ask you about. Was just an active versus passive, right? Maybe an ETF is not necessarily tracking a market index, and I like pulled off Kathy Wood's market innovation ETF, and like my question is like, all right, so people wanted to be put in ETF, but at what point does like marketing and Kathy Wood getting on TikTok talking about her gains like blur the line of what her funds are because they've been decimated? And I mean, I think anyone who's probably put a portfolio together themselves, it probably looks just like hers, but she's the trusted advisor to pour your money into. I mean, she was on TikTok this week talking about how basically her fund is going to like 30x for the next like 7 years. And it's just like, I would like to know, how do investors that want to be passive, like, not blur the line of like, okay, let me go here, 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 where like there's products that are just marketing down their throats to like jump in your funds.
Yeah, I wish you would do that. I mean, I understand that she's a marketer, she's a fund issuer, she's trying to attract interest to the product, she's trying to get money in the door. But I mean, this is where the financial media really does a service to a lot of people because um, they're just interested in getting eyeballs on TV or getting people to sign up for subscriptions on Kathy Wood's case, just really hype people up. And, and I know she did real well with that original Tesla call she did several years ago, and that's kind of rocketed her to the roof. But saying Bitcoin is going to a million and all this other thing, I really wish you would do that because it's just you get people hyped up and people are performance chasers. They want to pile into the next great thing. In the case of Mark, a lot of shareholders really hammered because they poured into the fund right at the peak and then they just rode it all the way back down. So, I know that's something you mentioned, and we know that inherently people need to drum up some PR for their funds and their business, but it's just something that I really wish they would do, and it's you know try to get the investors focused on their long-term goals and how funds fit into their portfolio is important, but it's not exciting. So it's just I wish the financial media would do that. I think it hurts investors as much as helps them.
I'll chime in on that real quick because I think there is sort of a harsh reality. I think when it comes to managing funds, and I'm a portfolio manager. I've got a mutual fund and two ETFs, and you know I'm very open and public about the frustration this year. Right, this kind of behavior of treasuries that really largely explains the drawdown that I've gone through from a rules-based perspective. The harsh reality is that like most fund managers, it's not like they're spending 90% of their day doing analysis. Right? I mean, once you have your portfolio, once you put your positions together, and certainly if you're rules based or quant driven like I am, where it has nothing to do with sort of your discretionary thinking, the reality is most of the other minutes in the day are spent largely on either marketing, content, or operational activities. Right? It's not like Kathy Wood is every single second of the day doing analysis. So and the harsh reality is that unfortunately, you've got to be out there. You've got to make people aware of what you do, and you've got to have people believe in what you do to release assets because that's the name of the game. Now, I do myself have an issue with the style of communication that I think, not necessarily Kathy Wood, but a lot of people in the industry do, I think, provide a false sense of confidence. And it's unfortunate because, again, the harsh reality there is that false sense of confidence in these bombastic claims often are what get the assets, right? So it's kind of like I always go back to that analogy. It's like who do you blame for being overweight? The waiter that's serving the food or the person that's eating it?
Yeah, and I get the point all the tech managers aren't doing their job or they're not doing the research because I know they are. With Bitcoin at 15,000, it's going to a million. It's just, you know that's just going to be that way. I don't want to take try to stir the pot, but you know it's going to get attention regardless of the research. So yeah, I think actually for the most part, you did a good job. But
me, it's wild some the claims, and that's really what I wanted to get at. Because like I even saw that a YouTuber, Meet Kevin, and he just made his own ETF, and it's just like, hey, what you're just gonna shield this to your 1.5 million followers, like, and to me, I don't know. The whole thing is kind of crazy, and that's kind of why I try to stay away personally from a lot of ETFs. I just feel like I can just put together my own product for myself without having to deal with the middleman.
Yeah, and Dave Portnoy is was a good example of it. He was putting together YouTube videos of like pretend press conferences, all this stuff. It did great out of the gate. Kind of middle ground. I don't even know the performance type take a look at it, but yeah, I mean, the bombastic stuff. I don't think it really helps.
Yeah, and I will add also, it's like, and we'll talk about sort of the rise of influencer-driven type of ETF strategy. But look, I mean, if somebody's got a following, it's not a bad idea to launch a fund. I mean, that's only going to take you so far, right? That's kind of like your early adopters with any kind of product launch. But I do also think, and this is where I do think it does become challenging for individual investors that are looking for different types of strategies. You've got to be able to differentiate between the face of the product and the product itself. Because the product itself, independent of what you might think of whoever is communicating or behind the strategy, may actually, like everything else, have a cycle that favors it, that one can take advantage of from an intermediate, long-term perspective. I think it's that blurring of the lines, David, is kind of a challenging thing, right? You need to have somebody be the face of an active strategy, but that face doesn't necessarily mean that the fund would follow sort of the mentality of that face, and the fund itself may be totally independent of that personality.
Yeah, and I mean, just from a fundamental standpoint, ETF strategy market is a great idea. It's kind of the perfect vehicle for that type of thing. And yeah, like vehicle, I think is a really good thing. A lot of people are familiar with that. And uh, but yeah, I mean, it's from the cycle, just like everything else. But if you do the homework, I'm always a big fan of saying, what's under the hood, just don't buy a fund because it's done real well lately. If you recommend the person's faces on it, unfortunately, you got to do the homework and know what's in there, and kind of know where you are in the cycle. But yeah, these funds can work. I don't disagree with that by any stretch. But yeah, I just think investors kind of need to know what they're getting into before they just say, yeah, I recommend that base. I'll throw my money at it.
Yeah, no, 100%. Let's go to Neely, then Miguel, and then David, if you want to chime in the coffee ground. But Neely,
David, I would love to just turn attention back to you and your process a little bit. I write for clients. You obviously write for a living, so if you talk a little bit about your writing life, that would be awesome. I would love to know. These are like the two things I'd love to know. If you didn't write about ETFs, what would you write about? And what's on your cutting floor right now that you think is just simply not getting enough time or attention? Thank you.
Sure. With what I write about ETFs, I've got a good silly answer, but I've always enjoyed, writing a fiction or something like that. So perhaps I try something like that. I guess I've never really thought about that. I think as far as if you were kind of talking within the realm of financial services, I think there are a lot of people who write about individual
a shortage of things to write about, even in the things that we're tasked to write about, that you think deserves more time and attention in 2023?
Um, I get, I get interested in some of these fixed income strategies that have been developed in the last year, ETFs that I think are really interesting. I think they've got some attention, but I think they deserve more because I think they really show cheaper for investors out there. Um, one of the right the trio funds that I'm kind of looking at right now are these specific maturity treasury bond ETFs that are out there. And one of the tickers is UTE and UTF. And I think that's for the 10-year treasury bond ETF. I think they have one for the 2-year and one for the 3-month treasury bill as well, I believe. But I think these are interesting because, if you're investing in a fixed income ETF, a lot of times your choices are you can invest in a 1 to 3 or 3 to 7 year or 7 to 10 year. These allow you to target specific maturities. And I think that's what a lot of people are trying to do in their fixed income portfolio instead of kind of invest in an ETF for some of the maturities and some of that is floating on a regular basis. So I think those are interesting. I think what blocks is doing some of their very specific targeted bond ETFs is really interesting. They just launched a series of ETFs that's targeting specific non-investment grade maturities. So you have a double B ETF, you have a single B, you have triple C. They also launched a family of income side, so you can invest in, healthcare insurance bonds and things like that. And it's something that just makes a lot of logical sense. I'm not sure why somebody didn't think of it before, considering all the funds that different very specific niches that they're launching nowadays. So I think those are funds that are under the radar. I don't think they have a lot of assets right now. I haven't seen a lot talked about them, but I think from a purpose of whether they're useful, whether they can fit the portfolio, I think these are really interesting products, and I think these are something that people probably should be a little more familiar with.
But those have an end, right? I mean, those ETFs will close when at maturity.
Actually, no. The 10-year treasury actually will just redeem the most recently issued 10-year and then just roll it over to the next 10-year. So it's got a very specific 10-year duration, 10-year maturity, and it just keeps rolling every 10 months. It's a little different than the bullet shares, I think it is, that have a specific target maturity and that just get retired when the maturity date is hit. So this is something that investors can literally invest in. Just know that they're targeting very specific maturity, but they can hold it indefinitely because it's just rolling over every month.
Go to McGill and then Nikoski if you want to chime in. Go ahead, McGill.
Good morning, Ben. Thanks for providing the space and conversation today. I really enjoyed watching the ETF space go from sort of it reminds me of the automobile industry where you basically have the Model T Ford. Like, it was like one solution, and now we've got this whole ecosystem, and I think it's remarkable. As somebody who's watched a lot of products come to market that was very self-serving, I think it's a triumph. And there's so many tools available to investors now. But one aspect of it that I'm really curious about is at the same time that exists, there's still among a lot of people a very myopic fixation on indexing and specifically indexing by market cap, whether people realize that's what they have conviction about or not. And I'm just curious to know if where you think that stands in terms of ideas, because I've seen alternative data, or however you want to put it, sort of chip away at that themes. But I'm curious to know where you think that stands you think that market cap weighting is ever going to lose its current status as sort of the king of the sacred cows in a lot of investors' minds? Um, and then I would be curious to hear what you have to say about short or inverse ETFs. Um, there are definitely some things that are not ideal about them, but I would love to hear what you have to say. Yeah. First question first. I don't think that large cap tilting portfolios is going to go away, but I do think it's going to change going forward. And I think a lot of that is, well, we've seen this for years, but I think it really kind of got spotlighted during the recovery from the COVID recession. Uh, Basically, the only thing that was really in play was large cap, large cap, mega cap, tech, and growth. You can just put your money in, Microsoft, Apple, Amazon, and you can just get these phenomenal returns. You didn't need to diversify. You didn't need to worry about small caps, international stocks. You just put your money in the handful of names, and you could just make money. So there was really no need to, diversify into different asset classes or worry about small caps or anything like that, because that's where the money was. This year, of course, the entire story has changed. We've seen value outperform. We've seen small caps outperform to some degree. People couldn't put their money into treasuries for safety, so they had to look elsewhere for income or for safety. And I think 2022 has really highlighted the fact that you just can't focus on large cap and mega cap and just expect it to beat the market all the time like it has the last couple of years. And I think that's really going to change how people look heading into 2023 and beyond, because if you look at the split between domestic and international as well, international stocks have trailed the U.S. for the last 12 years. I think emerging markets have had pretty much spent money for the last decade. And if you look at long-term cycles, you see that rotating on 10-year cycles at a time. International outperforms, the U.S. outperforms. We've been in that cycle where the U.S. outperforms. And I really think that the 2020s is probably going to feature international outperformance when all is said and done. I don't know if people are going to be positioned for that or if they're going to take advantage of that. I suspect that people are going to be looking for performance chase and they're going to move into it. But I think the reemergence of diversification is an important piece of portfolio strategy that's really going to grow in the next few years. So I think large cap investing is here to stay. I think it's going to change a little bit going forward. As far as your second question, as far as short and reverse, I think they serve a purpose. I think there's a lot of traders out there who use ETFs to establish very short-term positions, and if that's what they want to do, I think short and inverse ETFs are fine for that. I think some people use them as sort of long-term hedges or strategies. I wouldn't consider that because over time they're going to probably do pretty poorly. But yeah, if you want to bet against CPI report or something like that, you just want to establish a position for a day or two and take a shot at that. I think they work for that purpose. I think for most investors, these triple leverage oil and what have you. No, go ahead.
Yeah, so if you don't mind, I'd like to dig a little bit deeper on the not great performance.
Sorry, I don't know if you got cut off there at the end there.
Yeah, I think it's Miguel. I don't know if it's working for you. I'll try to go back to Miguel. Just raise your hand. I think.
Oh,
There
okay.
you go. There you go.
You know what? I think I muted myself. I'm back on.
Yep, you're good. A lot of people wish that I would mute myself. I understand. A lot of people wish I would mute myself. Sorry. Okay.
Sorry.
That's why I'm trying to avoid muting myself.
Yeah, so talk about performance. Would you say that like a slight breakdown in tracking error
or would you say that would you liken it to overpaying or uh, something along the same lines of uh, the decay that's sort of built into that process? You might overpaying for a expense ratio or something like that. Like how much that expect? I got to admit, I haven't spent a lot of time on these. I don't really pay attention to them, but I mean, I want to say there was some pair of short and long leverage ETFs. I don't remember which sector it is, but they're actually both down on the year. And on the trade, if you treat it as a long-term holding, I think you're probably getting a fairly significant amount of decay. I just want to put a number on it. I just don't know for sure. If you put your money into just say a triple leverage S&P 500 and the S&P is flat up here, I mean, it depends on volatility, of course, because that's going to make it worse. But if you see a triple leverage S&P 500 down 10% or more when the S&P is flat, I wouldn't be surprised to see that at all.
And actually, dude, I'll add a couple of quick thoughts on this. I studied this quite a bit when it came to the 2016 downward paper leverage for the long run. You hit on the right word, it's volatility, right? The enemy of leverage is volatility. So what people think it's decay. I know Miguel, a lot of people use that term. It's not really about some kind of natural decay. It's about the fact that when you're doing a daily reset in a market where there's a lot of seesaws, you end up grinding lower and lower because you're re-leveraging at the exact wrong time. So that point that David just mentioned, about a long levered ETF, a short levered ETF both being down, that's not uncommon. In 2008, I've always referenced this example, the FAS 3X long financial ETF and the 3X short financial ETF, FAZ, one's long, one's short. In '08 and one point, they were both down 70%, even though they're directionally supposed to be different. And that's because the dilemma is the sequence of the behavior of the path, right? This is where a lot of people do get, I think, screwed up in the way that they think about using leverage products, which is why, from a long term perspective, it can be really quite challenging to hold. And I'll even complicate it further, right? If it's really ultimately about volatility with leverage, well, we know that downtrending markets tend to be volatile, but downtrending markets actually then end up not being very good for short leverage funds because of the volatility in the trend, right? So there's a lot more complication to this, and none of this is news. I mean, you can look up the term constant leverage trap. It's sort of a well documented phenomenon, but it's really about path as opposed to some sort of embedded decay. But let me reset the room for the remaining 25 minutes here. But please make sure you follow my friend David Dierking. Check out his Substack, which has got some really great research as well as his work at the street. Again, this will be available as an edited podcast out of that Lead Lag Live banner. Let's go to the other phenomenal David, Mr. Nikoski. Go ahead, David.
Hey, David, in great spaces. Um, you write about, and I haven't seen some of your reports, but you also look at timing sectors and how do you implement that in the process?
As far as like market timing,
Yeah, utilizing sector orientation versus, just the S&P 500. Is that a process that you have put in place, and how do you manage that?
yeah, I don't do much market timing at all. Really, I shouldn't say much. I really don't do anything. Whenever I come up, it's usually I focus on what I think perhaps is more attractive at the moment. Right now I'm putting year-end or year-end review 2023, I guess I should say, as far as what I think might be better than others, but that's really kind of as far as I guess traditional market timing is not yet. I tend to focus
thought it was great that you revealed to the room that about emerging markets and the underperformance they've had for the last 12 years. From my side of the desk, been pretty much on that same key, and that the value investing versus growth is important. That I think you found out, and so I really appreciate that. And I think that helps give insight to everyone in this room, kind of the direction the U.S. markets have gone versus the foreign markets. And I think ETFs give a great avenue to get investments from geographic regions around the world. Yeah, absolutely, I agree. I think this is kind of where you see some of the bad investor behavior really kind of amplify results, because for a lot of people, things are emerging markets, and they're probably not going to go back until there's a year where it's gone up 100%. A great time to get back in again. Um, yeah, like anything else, it needs a very specific set of circumstances to really work, and we just haven't seen that over the last decade. But if you're a value investor, you're really kind of find a better deal. Some of these markets trade like 5, 6 times earnings. So from that standpoint, I think they still make great long-term holdings and great for diversification. So they're going to lower the risk in your portfolio. But yeah, as far as the breadth of products, I mean, it's just never been a better time to use the ETF market to invest in specific regions or countries or anything. I mean, even if you want to invest in emerging markets, say you want to stay away from China because what's going on over there, well, you have an ETF for that. If you want to invest in momentum stocks, emerging markets, you got an ETF for that. So if you're really looking to run almost any area of the market, the ETF industry is worth 3,000 different funds. You can probably find an ETF for almost every strategy you want to follow. That's a good thing.
So something that you may be aware of is, and I shared it in the nest. So David was one of the co-authors on the 2020 Founders Award paper, which came from NAME, the National Association of Active Managers, one of those 5 papers that I put out that's on SSRN. So we won the award with another guy named Matthew Bowler, but that paper basically documents a back test phenomenon whereby the idea essentially is you want to be in the most aggressive sectors, in particular tech, when the VIX hits like level 32, 33, and you actually want to be in defensive sectors when you're in a much lower VIX, which is counter, I think, the way a lot of the hedge fund community thinks about volatility. You'll attempt to degrowth and de-risk as the VIX is rising, rather than actually increasing risk. David, I don't know if you want to add some kind of color to the research that you and I had done on that paper, but from the perspective of you yourself being more of a buy and hold long-term investor after having done that research study with me, are you on the lookout for those moments to get more aggressive to tilt? Because you've got your asset allocation, but you can always overweight or underweight based on tactical, maybe longer term trend change.
Yeah, if you look at that paper, 40 pages long or something like that, it's full of charts and graphs and numbers and functions and all this and that. But when you get down to the core, it's really a very basic idea. The markets tend to go down, the fixed goes up, and when volatility is low, stocks do well. So it's really, we're just identifying a very basic kind of buy loss. You really, if the VIX goes up, you
And even though it's been 2 years, I know the big, most interesting finding from my perspective, which is actually what you had discovered, was that you end up having more sector dispersion the more elevated the VIX is, and kind of tighter co-movement the lower that is. And that's where there's an opportunity from a passive sector weighting standpoint to take advantage of sort of a dislocation. Right, the dislocations in terms of sector dispersions widen at a higher volatility than lower volatility.
Yeah, and I think if I remember this correctly, one of the interesting things about was tech actually did well in both scenarios, and that's probably a function of what the market has done, especially around the tech bubble and things like that. Um, but yeah, it was interesting to see how I think we broke it down into different tiers of VIX and broke it down by sector. You can see just very clearly that utilities and staples did well this quadrant. Tech did discretionary did very well in this quadrant. I mean, the results I think were pretty intuitive. I don't think anyone necessarily would have been surprised, but yeah, the dispersion of returns depending on the sector and where cyclicals did well, defensive did well, growth did well. I think that was a lot of useful findings in there. There's really a lot of market.
Let's go back to Miguel again. If everybody wants to come up and ask questions, just click that bottom left button. Go ahead, Miguel.
So, I had a chance to read that paper, so if I ask you something that's directly addressed in the paper, then I apologize. But as part of the discussion some years back about potentially using this as exposure, the same way one would use bonds or stocks as an asset class in the portfolio. In other words, rebalancing so that you end up selling VIX when it's after it's taken higher and buying. I mean, it would be a method for you would suggest that they could be not as specific as what you want. But is there an ETF or are there ETFs out there that do a good job of providing that exposure? It's one of the things that happened in the discussion is we talked about how to price that. And it just seemed like there wasn't, at the time, there wasn't a tool that really made a lot of sense because of the ones that were available, they weren't tracking the right, the method wasn't right. And so I'm just curious to know if there is a way to get exposure to VIX that makes sense, that doesn't have you sort of making a wrong bet. That makes sense. Sorry, I'm sure I'm my words here.
No, I get the gist of what you're saying. I mean, there are mixed-based ETFs out there, but they kind of should be treated as a class as the short term stuff. And I mean, one of them is a short VIX ETF, and that's what a lot of people use to sort of not just get try to make some easy returns off of volatility, but it's just like any other product, futures, actual underlying stock or bond. There's going to be some decay volatility that your potential rate of return is quite a bit. And you know, it's one of those things where people who work good, they can function reasonably well. In the short term, when they go bad, they go really bad. We saw back in early 2020, I think it was, with some of these fixed products blew up and lost like 99% of their money. So it's one of these things where if you're on the market at trade for a long time, it's going to go really bad. And I personally would not touch fixed ETFs just for that reason. Short-term traders might like them to make a quick bet on things, but I mean, to answer your question, yes, the products are not. No, I wouldn't use them because I don't think they're really tied to VIX very well, especially after anything like a couple of days.
Let me add a quick additional kind of note on that, which is so I shared it in the nest, and this actually relates to sort of the flight to safety behavior and why I always go back to this idea that treasuries historically are a beneficiary of stock market volatility. So if you were to overlay the VIX, spot VIX, right, against a ratio of long duration treasuries like a TLT divided by IEF, you do a rolling sort of return on that. You can see very clearly in the pinned tweet in the chart that when the VIX spikes, long duration relative to intermediate really outperforms, spikes in a similar way. That's the risk off. So to answer your question, at least from my vantage point, I'd argue that a better way to play the VIX is oftentimes simply to play long duration treasuries, and at least that way, if you're wrong, you at least have a chance in making money because there's positive carry. But the problem with the VIX, as Steve correctly pointed out, is they're futures based, there's roll, so you end up having this kind of fight against time. You might be right about volatility rising, but by the time it happens, you've eroded so much, right? Just from the premium going away. Treasuries, at least time is at least in theory on your side, obviously higher the yield. So just an added thought, David, on that. I think it's people want to try to play volatility with these products, but sometimes the simplest way to play volatility is just with treasuries.
Yep, yep, 100% agree. I think it, what do you think, 2020, the big trade was easy because volatility was really low for an extended period of time. People just thought that was free money, so it was short thing. It worked until it did, but yeah, it was, I think treasury is working on generally over time. They are working with this risk and get a return yet. So yeah, I would agree. That's a good way to go.
Um, let's talk about some of the negatives for a moment of ETFs as a wrapper, which there are some, and I don't think they're obvious in how they're negative. I'm sure you've seen these studies too, David, but I've seen plenty of studies that would suggest that investor returns in a mutual fund tend to be higher than investor returns in the ETF of the exact same index strategy. And it's not because of fees, it's just simply because people will trade an ETF more than a mutual fund. Right? Because an ETF is priced second by second. There's a temptation to trade during the day, whereas with a mutual fund, it's priced just once a day. Um, how do you think about sort of the investor behavior changing because of ETFs? And it seems to me that it's maybe increased short termism.
Oh, it's absolutely increased. I saw a chart on there, I think last week or two that said right now about 40% of ETF volume is being held for less than 24 hours. And I mean, years ago, during father's generation, people would hold on to stocks for years and years. About 7 years. Now we're measuring it in days now. So yes, I 100% agree. It's turned investors into traders, outside of just there's it maybe commission free, and I think that's another big part of the issue. But there are these kind of traders who work in, and that's going to you're moving in and out. That's going to cost you time. But yeah, I agree. The advent of commission free trading has really brought a lot of bad behavior in the ETF marketplace. Um, I think as a structure, ETFs work really well. But yeah, some of the behaviors that they encouraged is just been counterproductive. It also masks some of the underlying issues with some of the securities they invest into because you sort of get this illusion of liquidity in almost any ETF you have, but you also have to realize that that's the liquidity of the ETF. There's the liquidity of the underlying security within the ETF. And that gets
And I will say it's also the illusion of illiquidity, right? Because people will see a fund that really trades, that doesn't really trade actively in terms of volume, but the underlying could be as liquid as it gets, right? It's always been sort of a fascinating dynamic too, right? I think it's almost easier to raise funds for a mutual fund than for an ETF when you're newer because you don't see volume with a mutual fund, so it's not a deterrent. Whereas you might see volume for an ETF, and people say, I'm not going to touch it until it's trading an average of 10,000 shares a day, and it may never get there because they're missing.
Yeah, and I think they would trade very thinly because if you look at the charts on that, you'll have one trade at $10 shares, the next trade will be at 75, like that. You don't really have a good handle on these two, what price you're just getting in and out at versus SPY. There's almost no spread on that at all. So, yeah, those liquidity and liquidity is something I think you really need to keep an eye out on.
As far as ETF fund flows, I'm curious if you've done anything recently, kind of studying where new trends might be emerging there. I mean, there's been this story that's been circulating the last couple of days around how there's probably going to be a massive rebalancing from year end from a flow perspective as institutions sell stocks and buy bonds, which makes some sense because of target weightings. But anything that's been intriguing from your standpoint as far as fund flows?
Yeah, there's one thing that I spent some time looking at the last few months that have given flows into and out of the treasury ETFs actually. The one interesting thing I found in September and October, if you look at the flows into treasury ETFs overall, you saw the vast majority of money was moving into short term and ultra short term treasuries and money was moving out of long term treasuries. So if you want to assign it, and people they'd have enough volatility to if they're moving their cash essentially to the sidelines. For the last month or so, that trend is completely reversed. All the money is moving out of all the short term, and it's going back into long term treasuries. So I think people are realizing that perhaps there's potential again on the interest rate trade and on what treasuries are doing. People are finally treating it as kind of borrowed rate, we like to say, immediately from a stock asset. Again, I think investors are starting to identify that right now. So I think that's a trend that could very well continue. On the equity side, it's, there's just so much money pouring into ETFs right now that in a lot of cases you just see positive inflows regardless of what kind of market environment it is. And what's doing well and not well at the moment. I've been a little surprised to see that tech ETFs have seen pretty consistent inflows throughout the year, despite what they've done this year. I think some of the cyclical areas of financials is kind of going up and down a little bit. We saw a perfect example from one of the first half of the year. We saw a lot of money, a lot of ETFs really for the first time in years, maybe ever. And then oil prices started turning around. Everything kept went down again, and then you saw the money come right back out of it. So there's still a lot of performance chasing in the flows, but as far as what has been really interesting, I think that treasury flow ETF behavior that we've seen sort of going into safety and then kind of reversing itself back out. I think that's something that I think is potentially interesting to watch in the coming year because I think it shows that investors are giving a chance to treasuries again, despite what happened in 2022.
Do one more question and then wrap up. Go ahead, Miguel.
So it's been a few years, but back in the day, I remember that Putnam would roll out the timely product, I'll call it, seemingly at the top every time. I think they had an incubator system. Maybe they still do. I don't know. I just haven't really followed them as closely as I once did. And so in a period like you just described for commodity mean somebody that sort of jumps on the trend after it happens?
Yeah, somebody that panders and when they launch, you think, oh boy, it's fun.
I'm not sure there's a specific issuer that I would point out to do that, but I would say the industry as a whole does a real good job of kind of showing up and trying to sort of try to keep their peace of mind. A good example this year would be inflation, like the ETFs. We had TIPS ETFs out there forever. Continue to do good business, but you saw a flood of inflation ETFs launches here, whether it was specifically tied to tips or tied to commodities or tied to commodities in sensitive sectors, financial security, or something like that. There's the ETF industry has a real way of sort of firing here at the end of the trend, kind of offering all these new products. Certainly, investors may have this type of thing, but a lot of them launch, a lot of them compete with each other and sort of cannibalize each other a few years. There's no end of assets or something like that. With issuers looking at whether this type of close or they not going to get something. I think that trend will kind of always exist. I think issuers are they're issuers that are trying to get attention. They're trying to make money too. So it's completely understandable. I don't fault them for doing that. They're in the business of making money like everybody else. But I think from sort of a contrarian indicator, I think when you see a number of ETFs popping up and sort of following a similar theme, it's kind of one of those things where you have to ask if you're kind of near the end of the trend or it's sort of played out at that point.
You saw that, by the way, with a lot of blockchain ETFs, right? That just like suddenly they all started coming out pretty much towards the top there.
Yeah, blockchain ETFs, you probably don't have money ETFs for that, but talking well, how much of those and then especially when you start getting the inverse ETFs or something like that, that you don't have.
Are you good for one more question, Dierking? Just because I know we're over here.
No, absolutely. Go ahead.
And I will say one other thing. I mean, this is that point about Putnam Mill. I mean, it really is true, and David hit it correctly. I mean, Wall Street wants to raise assets for funds, which means there has to be some kind of existing trend in place for people to chase once it's available in an ETF wrapper. But because the ETF launch process takes time, it can 3 to 5 months depending on the complexity. Oftentimes, it's that delay of actually getting it to market is kind of where the peak kicks in. It is funny to me how people seem to think that somebody has an ETF idea, it happens overnight. It's a long process just to perfect thing. But let's go to Mr. Koski, and then I promise I'll wrap up there. Yeah, for sure. Go ahead, Dave.
I love the know that I love that last question regarding ETFs pop up. The other side of the coin is you see a lot of ETFs actually close down before big run-ups. If you look at something like the coal ETF, well, literally shut down. I think in June 20, that was the very bottom. I mean, the very bottom of the stock. There's examples in history when you look back at, back in March 1st of 2000, Tiger Value Fund, which probably would have been its best performance ever in its history, and that was an ETF, it was a mutual fund. They shut down March 1st, and the market peaked out, March 6th or March 9th of 2000. And after that, it was, all the money went into value funds and tech fell apart. So I think it's important to look at both sides. When a fund closes, that can also be the bottom because they can't attract the capital.
No, and actually, no, and actually, I'm so glad because I kind of went through this even myself with my mutual fund prior to 2020. Right, in this thought process, I get it as a business manager, somebody's an issuer. You don't know when you launch a product if it's sunk cost fallacy. It takes a lot of money to launch a fund, bring it to market, do the marketing, all that stuff. You don't know if it's sunk cost fallacy when you think about closing, or if you're selling low for the strategy. and that's it's a business decision. But you only know with hindsight.
I'll add one more thing on that. Performance doesn't necessarily successful ETF either because we had, I don't remember how many it was, it's probably about 2016. We had the obesity ETF, our ETF, I think the ticker symbol is SLIM. So great ticker, great premise, and it had fantastic performance. I mean, it lagged not only well, it was the S&P 500 too, and then if you were performing changing out at the time, I don't think that they ever got over like the average 12 billion in assets. People just didn't invest in it for whatever reason or another, and then after a year or two, it closed down and just never achieved scale. So there's just all sorts of issues, like you mentioned. You can get it out at the wrong time. You can have a great story. You can have a great track record. Sometimes these things just don't catch on. They'll start to don't commit to it. So I'm sure if I look at investors quite well, the ETF industry is just a real hellscape, and it's tough to really succeed, especially now when we have thousands of ETFs to compete with. And probably from a marketing standpoint, naming a fund the obesity index is contra what anyone might want, right? Well, yeah, there's probably the aspect of, if I sort of doing the right thing by investing in the obesity epidemic, that's something you want to hear, you don't want to problem. Yeah, there's a lot of
They should have been a 3x short obesity ETF that delivered slim. Anyways, listen, everybody that's here, please make sure you follow my friend David Dierking here, and everybody up here. Neely is always great for questions. Great follow as well. David Koski, as well as FCF, the Fried Chicken Man itself, and Miguel. I will do another several spaces as usual this week. Thank you everybody for joining. Please keep on eating healthy and don't invest in obesity. Good stuff, everybody. Cheers, everybody. You gotta teach me how to put that on sound. I don't know how you do that. Thanks, everybody. Send me a DM. Send me a DM. Yeah, magic one. There. Okay.